All right, so today the market gave us a real masterclass in what headline-driven volatility looks like. It was a dramatic tug-of-war between hope and, well, reality, and it all centered around that US-Iran ceasefire countdown. Let's break down exactly what happened.
So here's the game plan. We're going to start with the geopolitical news that really whipped the indices around, then we'll zoom out and look at the bigger macroeconomic picture. After that, we'll dive into how some key sectors held up, check in on some major company updates, and then finally, we'll dig into the market's internal dynamics.
First up, let's talk about the main event, the thing that was really driving all the action today. And that was the rapidly shifting story between the United States and Iran, which honestly, it played out like a high-stakes negotiation in real time for all of us to watch.
I mean, the day was a total roller coaster. It all kicked off with President Trump tweeting about a great agreement, and that sent the indices rallying right at the open. But then Iran pretty quickly pushed back, saying, whoa, no decision has been made, which just threw the market into this choppy, uncertain mess. Then, just before the close, Iran delivers the final word. They're not coming to the talks. And boom, the indices just took a sharp dive. But the story wasn't even over then. After the bell, Trump announces a pause on military action, saying it was at Pakistan's request, which really just felt like a way to save face after the whole thing hit a wall.
Now here is the most important piece of context for the whole day. Yes, the Iran headlines were absolutely driving the minute-by-minute moves, but the reality is the market was already kind of running on fumes. Think about it. We'd had this massive 13-day run-up, and things were getting what we call overbought. A pullback was basically inevitable. So the crucial takeaway here is that all this geopolitical noise, it was really just the excuse the market was looking for to take a much-needed and, frankly, pretty healthy breather. Okay, so let's zoom out from the intraday drama and look at the bigger picture. What's going on with the underlying economic data and what's the Fed saying? This is the stuff that's shaping the bigger story for investors. You know, a key reason that today's pullback didn't just spiral into a complete rout is the fundamental strength of the U.S. economy. The retail sales data for March came in really strong, the biggest monthly jump we've seen in almost a year. And that kind of resilience, it provides a solid floor for the market, even on a crazy volatile day like today. Meanwhile, we were also getting a look into the mind of the potential next Fed chair. During his confirmation hearing, nominee Walsh laid out his whole philosophy. He pointed a finger directly at the Fed's own policy mistakes for the recent high inflation, and he argued that keeping inflation low is actually a shield that protects the Fed's independence. He promised a cautious approach to shrinking the balance sheet, and while he made it clear he wouldn't be a puppet for the president, he was, very deliberately vague about where interest rates might go. Okay, so let's see how all these big-picture themes actually trickled down into the performance of different sectors. And what we saw were some really interesting and, in some cases, pretty counterintuitive moves.
So, starting off in healthcare, United Health was the absolute star of the show today, leading the S&P 500 after a fantastic earnings report. Just look at these numbers. They beat expectations pretty much everywhere. Adjusted earnings per share, $7.23, which just crushed the $6.57 estimate. And what's more, they raised their guidance for the full year, which signals real confidence in their business.
But what's interesting is that this strength in health insurers wasn't all about the same thing. For United Health, the rally was really about their own great execution and their diversified business. Humana, on the other hand, their recent strength has been more about what you'd call a policy tailwind, in this case, getting a better-than-expected payment rate from Medicare Advantage, which lifts the outlook for the whole industry. All right, now for one of the biggest head scratches of the day. You had Raytheon and Northrop Grumman both report really strong earnings, and you had escalating geopolitical tensions. That combination should be rocket fuel for defense stocks. So why on earth did they sell off?
Well, the answer is a classic case of sell the news. The defense sector was already what's known as a crowded trade. That just means pretty much everyone who was going to buy these stocks had already done it, pushing the prices way up. So when the good news finally hit, there were no new buyers left. It was the perfect signal for all the existing investors to just cash out and take their profits. Plus, the long-term nature of defense contracts means there's not a lot of immediate upside, which gave all the short-term traders a reason to bail. And we saw a very similar pattern in the aviation sector. Stocks started strong but then reversed. You had companies like GE Aerospace reporting great results because travel demand is so strong, but the market's focus just shifted right over to the threat of rising jet fuel costs because of the conflict. Alaska Airlines even pulled its full-year guidance, specifically blaming higher fuel costs, and that just put a cloud over the whole group. All right, let's switch gears and take a look at some of the biggest individual stocks out there and the company-specific news that was moving the needle for them today. So,
Amazon announced it's getting even deeper with the AI company Anthropic, and this is just a brilliant strategic move. It's a perfect loop. Amazon invests billions of dollars into Anthropic, and then Anthropic turns around and commits to spending over $100 billion on Amazon's AWS cloud services. It's an incredible way to lock in a massive, long-term customer for their most important business. Now, over at Walmart, the stock has kind of been lagging a bit as investors have been rotating out of those safe, defensive names and into tech. But there is a pretty big potential catalyst on the horizon. According to Citi, Walmart is set to get a tariff refund estimated at $10.2 billion. That's a huge boost to their cash flow and balance sheet.
And at Apple, the CEO succession plan we've all been waiting for was finally confirmed. Tim Cook is going to become executive chairman, and the head of hardware, John Ternus, is taking over as CEO. Honestly, this was a very well-telegraphed move, and the market pretty much took the news of the orderly transition in stride. No drama there.
Okay, for our last section, let's peel back the layers of the market a bit. We're going to look at a fascinating special situation and then wrap it all up with the core theme that really defined today's trading action.
The absolutely bananas move in the stock of Avis rental cars today gave us a perfect, real-world example of a short squeeze. This is what happens when a stock that a lot of people are betting against suddenly starts to rise. It forces all those short sellers to scramble and buy back shares to limit their losses, which just pours more fuel on the fire and sends the price even higher. It's a vicious cycle for them.
And this chart right here, this shows you exactly why it happened. The whole thing was triggered when a hedge fund, Pentwater Capital, announced it had scooped up a massive 22% stake. Now you combine that with the almost 50% already owned by another firm, SRS, and you see that over 70% of the entire company is locked up by just 2 players. That severely limits the number of shares available for everyone else to trade, trapping the short sellers and sending the stock to the moon.
So if there's one thing to take away from today, it's this. If you just glanced at the S&P 500, you might have thought it was a relatively calm day. But beneath that surface, there was this fierce, aggressive rotation of money happening. Capital was moving decisively out of areas like defense and flowing into others like healthcare, all based on earnings and the shifting stories of the day. This internal divergence, that's really the key takeaway. It's a huge reminder that the real action isn't always what you see in the headline numbers. And it leaves us with a critical question for this kind of market. When things look steady on the surface but are turbulent underneath, how do you figure out where the real risks, and of course the real opportunities, are actually hiding?